default rates, I would say we certainly expect an increase, and the market is certainly expecting an increase in rates or in default rates. For example, the recent JP Morgan forecast is for 3% of high yield and 3.5% of leveraged loans to default. That's roughly double the current rate of defaults. I would say Moody's has somewhat higher expectations. The interesting thing about that is, even though it's double the current rates, it's really about equivalent to the historical average. We've seen recessions kind of customarily show, 6 to 10% default rates. So the current forecasts, at least, are not to get to that level. I think as David mentioned, current distress levels are up and are roughly double what they were before, which sort of supports that expectation of increasing default rates coming down the road. So the market is certainly, kind of looking for that. The interesting thing about this market, and David mentioned a little bit of this, is that the high yield market may actually be better off than the leveraged loan market this time around. And it's a lot of those highly leveraged deals don't have high yield. They kind of are all leveraged loans. If you look back to the 2007 market, loans were mainly a double B asset class. High yield was really roughly in the B2 range. That's flipped a bit, and right now 40 to 50% of high yield issues are BA3 or better, where leveraged loans really average roughly B2. So what we may see is we may see leveraged loans do much worse off this time as compared to high yield than we've seen in previous downturns. The issue borrowers are having, obviously, is that you have a combo of a slowing economy and maybe a recession and rising rates. And those two things are kind of crimping cash flow from both sides. For the high yield market, the good news is debt to EBITDA is really kind of at historic lows for high yield. Liquidity is pretty strong. In the leveraged loan market, it's really the opposite. The level of B3 or worse paper is really high. You have CLOs right now holding a relatively high level of CCC paper, and they have limited buckets for that. So we could see, if we see a wave of downgrades, we could see some increased CLO selling, which kind of could lend to that further distressed debt level. As far as fallen angels, it's really going to depend on the economy. If we see a deep recession, we certainly could bring a wave of downgrades. The good news, at least in the high yield market, is you have about $160 billion of high yield paper that is close to and maybe expected to be upgraded to investment grade, which potentially will lead to a shrinking of the high yield market in 2023 as more of that paper moves up than new paper comes into the market. Some of those rising stars, for example, kind of in the energy sector. For example, Occidental Petroleum, a large issuer, is right now kind of on the cusp and maybe expected to be upgraded to investment grade. So we may see the high yield market do a little better. The leveraged loan market may get punished a little more than previous years.